time to join us today. But first of all, most importantly, is I just hope that everybody's family and friends are fit and healthy during these challenging times that we're in at the moment. So, like I said, I hope everybody's fit and well. My name is Rob Whittall. I'm a partner at Dyke Yaxley LLC, and today, with myself and my colleague Julie, we're going to talk to you about the payroll protection loan and the potential forgiveness of the loan. Obviously, this has been most the talking point over the last few weeks from a business perspective in the US. But before we start, just a couple of housekeeping points. Everyone on the webinar is in listen-only mode. However, you should see a question box that you can type in a question as we go along that we'll try and answer. As I mentioned, we'll do our best to answer your questions. However, I have to be honest with you and let you know that we may not have the answer to your question. The reason being is that this PP loan forgiveness rules are changing on a frequent basis. But if we can't answer your question today, we will definitely follow up with you directly and make sure we get an answer to your question. And by the way, thank you so much for giving me the opportunity to wear my tie for the first time in 3 months. It feels special to be able to get dressed up for the day. As mentioned, please note that the Payroll Protection Program is in constant flux. And as we talk overnight, the Payroll Protection Program Flexibility Act is sitting on the President's desk to sign, which is going to change some of what we're going to talk about today with specific sort of time periods. However, Julie and I thought it was still important to continue with the webinar to let you know what we know at the moment. And it is our intention to follow up in a session in a couple of weeks' time to let you know of any updates and changes that have occurred so that you have the latest information. So the main purpose of our presentation today over the next sort of 40-45 minutes is to share with you what we've learned about the Payroll Protection Program and the loan forgiveness over the last few weeks and help you navigate through the process of filling out the loan forgiveness application form and gathering the document you need to support the loan application as well. I'm going to start by discussing the various aspects of the loan that you should be aware of, and then Julie is going to join us and go through sort of an example of the loan forgiveness calculation and also provide you with a resource to sort of get a hold of a loan calculator, which the AICPA has put out and which is being updated on a regular basis as the rules change. With that being said, let's make a start. Next slide, please, Julie. So, as mentioned before, from an overview perspective, the PPP legislation that's out there is in constant flux. And really from today, we really want to give you an overview of what we know and go through and explain to you what you should be doing now, getting in preparation to submit your package to hopefully have all the loan that you've received forgiven. Next slide, please, Julie. So these are just a few facts, and I know normally information from a week ago is fairly up-to-date information, but everything's changing so quickly at the moment. But as of a webinar I was on last week, last Thursday night, to date, 4.45 million loans had been given a total loan amount of 510 billion. But what's interesting, and I think most people on the call today would most probably resonate with this, is the average loan size that people have got is about $115,000, but there you can say is over half are less than 50,000, and over 75% are below 100,000, and there's only a very small amount that are above 2 million, and that 2 million mark is an important mark that we will talk about a little bit further as we go through. Now, what's interesting, and I must admit, from a person perspective, and I think most probably dealing various members of the team, most probably having dealt with all the attendees on the call, is this: it's been a frustrating process with respect to getting hold of these funds at time. And I think with our client base, I don't think anybody got any money in the first round, because at that stage, I think the banks and the lenders were having a lot of problems dealing with the foreign ownership. But then in the second tranche, a lot of our clients were able to get that. However, still now, there are still banks that still aren't understanding that foreign-owned companies are eligible for these loans, which has been very frustrating from your perspective or from our client's perspective, and also very frustrating from our perspective, because we felt that we really want to help and we haven't been able to. So it's been very frustrating. And what seems to be happening at the moment is that there's still money out there, but we can't get a hold of it because the banks, for whatever reason, have decided to stop processing loans. So although the idea behind the program was great. I think unfortunately because it had to be rolled out so quickly, there was various kinks. But in fairness to everybody behind the scenes, is to be able to get as much money as they could get out to the amount of people in the short period of time has been a pretty phenomenal feat in itself. So there's a few things I would like to discuss just for people to not be concerned about, but just be aware of. So the big issue had been when the loans had first come out, is there was a question on the application that talked about is on the, as you'll most all remember when you signed it, you had to initial next to a statement that said current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. The problem was that is all the guidance we had. There wasn't any more guidance at all. Is had your revenue dropped by a certain amount, were you going to have to lay off employees? It was such an open thing that basically what happened was almost everybody, every man and their dog seemed to have applied, and that basically meant I think it was within less than 2 weeks that the first pot of money had just disappeared out of sight. So then people started asking questions, and the Treasury came out with some questions under the FBA, and they issued sort of 4 questions that sort of talk about the current economic uncertainty. And if you click on that link from the presentation, that'll take you through to all the questions. But in reality, what they did is they put some questions in, sort of saying is, you've sort of got to go through and work out if you've got funds from other places, or you had spare cash reserves, etc., etc. And then that sort of caused everybody on the flip side to sort of panic the other way and sort of go is, well, I've got some money left in the bank. Should I be applying for it, or should I return the money to the bank? And it became a discussion for quite a few weeks on webinars that I was on, is where was the right balance for the pendulum to sort of stay. To start with, it was way too liberal, it appeared, and then it was almost like it became way too stringent. And the second link down there was a blog that the AICPA put out, and basically what they were saying there is that if you're a small business, and in effect is you have uncertainty in your business, is you should still be able to apply for this. And if you click on, there's a little article there that talks about the intent of keeping the funds, because I think they realized that there were certain businesses, and if you read on the media, there was a few publicly traded companies that actually took the money, and what the SBA said is, you've got access to monies elsewhere. This money here was to be able to provide money to small businesses to keep employees in work, and those businesses didn't have anywhere else to go other than maybe the owner's pockets, the owner's personal assets, if they had a line of credit. But it was people that didn't have adequate ability to get funds quickly. Next slide, please, Julie. So what they sort of then went thing is, even though it seemed as if they had opened up, the fact is if you're a small business under 2 million, that you basically didn't really have to worry about taking the money. That wasn't sort of, even though that was the implication from when I've been listening to different things, it seems as if you still need to just look at your own self-assessment of the need of the money. Because you also do need to be aware that the recipients of these loans will be a matter of public record. So at the moment, we don't know exactly what will be disclosed, but we're almost on what I'm listening to, it's almost 100% sure that the name of the company that borrowed it, or the name of the individual, if you were self-employed, that borrowed it, will be on a public record. Whether it goes any further, or whether it just goes, if you remember on the front page of the application, there was an ownership, you had to list there any 20% greater owners, whether that's now within the SBA's hands, whether that will be there, and also the amount of the loan. So you just need to be aware that at some stage, nobody knows when, but the fact that if you did receive the money, it will be a public record out there if somebody was trying to look for it to see who had borrowed monies. Now, there is also a thing out there, they basically said that all loans that were taken out in excess of 2 million will be reviewed. But if you're under 1 million, under 2 million, then it does say that others can be reviewed as appropriate. Now, once again, is everything I'm reading and listening to, obviously the SBA or the SBA auditors or the bank auditors or whoever will be looking at these loans and reviewing the underside, they've only got a finite amount of resources. And I suppose I'm thinking, if somebody borrowed 20,000 from the bank under one of these, under a PPP loan, what's the risk, or what's the likelihood of those documents being really audited? I'd imagine fairly low. So I would imagine they would most probably look at loans that maybe at the time they were a bit concerned about, maybe it was an industry they didn't think needed it, or it'll be on the size, because I think it's just going to have to be a random sample because they're just not going to have the resources. Next slide, please, Julie. But what you should do, and this has come up several times, is because at the moment we're talking about that if those loans are ever looked at, it could be 2, 3, 4 years down the road, because it would appear there's like a statute of limitations of 6 years. So what you should do now, and this is most important, is draft together a memo now and document now the quantitative and qualitative facts that you took into consideration when you applied for your PPP loan. So what cash reserves did you have on hand? What were the immediate underlying business trends that you're seeing? Was there an immediate decline in revenue? Did orders all of a sudden stop? Were you shut down by the business, by the government in the US because of the industry you were in? Were people within your supply chain, or either customers or suppliers, were they shut down, which had an immediate effect to you? So all those sorts of things, I think while this is all fresh in our mind, it is a very valid time and a very valid exercise to go through and note those down. It could be a 1-page document, it could be a 5-page document. Obviously, the more information you have, if ever you are looked at and this question is ever asserted, is did you really need the money? Then you've got documentation there and it's dated as of now, as opposed to 3 years, 4 years down the road when you're trying to remember exactly what went on. Other things you could take into consideration is, were customers calling you to renegotiate terms? For example, deferment of payment, asking for discounts, all those sorts of things. Next slide, Julie.
One more.
No, that's it. No, so other thing is vendors. Were your vendors asking you to prepay or payments in full, whereas maybe normally you had terms of 60 or 90 days? I know not from a business perspective per se, but certainly from a personal perspective, I know there were certain things I've got going on that I had people sort of calling and going, well, can you just settle that now? Can you do that now? So I'm sure various ones of you out there maybe had that with people that you owed money to, asking for money now. Are you experiencing a change in your customer base as a result of this? Are you having to redesign your processes? Are you having to go to market with a different product? Are you losing customers? All these things are very important things. If you can document now, just in case you need them. Now, if you do look at the SBA frequently asked questions 31 and 37, you will see in there they do talk about, do you have other sources of liquidity, access to liquidity from the parent company? So in reality is they could most probably, and it's maybe worthwhile documenting this, I was thinking about this the other day, is that it might make sense that even if there is liquidity or there is a parent company, that maybe you document how the parent company was doing as well. So obviously most of our situations we could have a UK parent with a US sub. It makes sense to document that most probably in the UK, what was the UK market like? Were you slowing up there? So in effect, there wasn't spare liquidity to loan to the US company. Were you having to put people on furlough in the UK? And those sorts of things, I think, in case they come back and say, oh, was the parent company, how was that doing? You've once again documented that now in case you're ever asked questions about it. So, like I said, I don't think I can stress enough, it's important to get that done. And to the detail you decide to go into it, I think it's just the more evidence, the better. Expense deductibility. So this is interesting. So a couple of weeks ago, I think the middle of May, as everybody's aware, the idea of this is you're given a loan, and if you use the loan for the appropriate expenses and you meet the requirements, then in effect the loan is forgiven. So normally, from a tax perspective, when you have loans forgiven and they're not taxed, and specifically it said it's not taxable, is you don't pick that up in income, even though it's been forgiven. The normal rule is when you have debt forgiven in the US, it comes in as income, but under this, there was a special rule that was put out in the CARES Act that basically said the loan forgiveness is not taxable income. So what the IRS has come out within a notice is basically saying, and they've gone through their rationale, and what they've basically said is that normally when you have tax exempt income, so they're referring as like tax exempt income, the expenses relating to that tax exempt income are not deductible. So they're trying to make the argument that if you have a loan of 50,000 and you spend it on payroll for 50,000, that deduction, you don't pick up the income of the loan forgiveness and you don't take the deduction of 50,000. So in reality, the benefit to you is the tax effect of the cash that was the after-tax cash. That's your saving or your benefit. But there is, once again, pending legislation out there that's wanted to be put into place that basically says is that the loan forgiveness is not taxable income, and that 50,000 you spend on wages, the business can deduct it in full. But as I put there, it's to be continued. It's in, I think it's in the HEROES bill that's sort of on the way through Congress and the Senate at the moment. So I think the gut reaction is, from when I'm listening to stuff, is that it will be deductible at the end of the day. But at the moment, the IRS's initial position is you shouldn't get a deduction for the deductions that the loan was used to pay. Next slide, please, Julie. So I think, as I mentioned earlier, there is some pending legislation, and it's been sort of pending, going through the House and the Senate over the last few days. And it would appear that last night the Senate signed off on it, and there is a bill that's going to be sitting on the President's desk. I tried to find out some more information, exactly what was in the final bill, and I was just having to go off what I could see in the press today. But I think everybody's aware is originally you had an 8-week period for this loan forgiveness. It would appear potentially that it might be going up to 24 weeks. Now, that being said, my understanding still is if in effect is you would have spent all those monies within the 8 weeks on expenses and you've used all that money, then I don't think there's any reason that you don't necessarily put your application in and get it forgiven. But it would appear that if in effect is for various things you aren't able to have spent all that money on requisite expenses, payroll, rent, utilities and that to meet the requirements, they are going to give you an extended period of time to do that. It would also appear that instead of having to meet this 75% threshold on the payroll, meaning that so that you can only spend 25% on non-payroll expenses and still get a full loan forgiveness, it might go down to 60% instead. And as long as the other 40% is spent on utilities and that, then that's still good. But the one thing that Julie and I did see yesterday when we were looking at it is, and I'm not sure what ended up in the final bill, but there was a possibility that if you went down to 60% of the payroll, that if you didn't meet that 60% test, then in effect is none of the payroll counted. Now, I'm not sure what's in the final bill, but we'll just have to wait and see what comes out. Also, with respect to your full-time employees and rehiring people, if you had to sort of lay people off, it would appear instead of looking at a June 30th date, they may do a December 31st if you needed to go that far out. And also, as everybody is aware, to the extent that you took the money out and you didn't use it, then it was deemed to be a loan that would have to be paid back within 2 years. That would appear that might be extended. What I sort of saw last night, it might be 5 years. So all these things are waiting to sort of come out. It would still be a 1% interest rate from what I'm reading. The one thing that I'm sure everybody is aware of, but it was something that just came to my mind over the last sort of 2 or 3 weeks, is that even though the full amount of the loan will be forgiven if you meet all the requirements, because it is a loan, there is interest charged on it at 1% from the day you got it. So say, for example, you got the loan on, I don't know, so on April the 15th, and by the time you get all your paperwork in and the bank comes back to you and it's forgiven by July the 15th, you will still have to pay interest from April the 15th into July the 15th. Even though you won't have to pay any principal back, you still will get a charge of an interest charge. So don't be surprised that whatever paperwork you get at the end of the day, that there will be some interest on there, and that's the reason why. Next slide, please, Julie. The other thing that with this, talking about the loan forgiveness and the documentation and tracing everything through, I know I've spoken to some people about this, but the one thing, if you were able to, is if you were able to put the monies into a separate account, that's always a better thing, because then it's easy to trace where the monies came in and exactly show where they went out. I don't think it's imperative. I know there's one or two people I've talked to that were able to do that. I also know there's one or two people I talked to who said it was just going to be such a hassle to set it up with the bank that they were just going to track it in the same sort of regular operating current account they were using. But what you've got to do is you're going to have to make sure that you start putting together now, and it's most important now to think about putting together this loan forgiveness documentation. So you're going to have to put stuff together for the payroll, and it's going to be things like bank account statements showing the money's coming in, showing the money's going out, IRS forms, so your 941 payroll forms, your motorway payroll journals showing what you paid everybody, the names of the employees, and then with respect to health insurance payments and retirement payments that you made, then you would want to make sure you've got those in place, you've got documentation for those. Please remember that the only piece that you can do for the health insurance and retirement plan payments is the piece that you as the employer incurred for the employee. So for example, at Dyke Yaxley, we pay 50% of the health insurance for the employee, and the employee pays 50%. The question is, when we pay the insurance bill, so say it's $1,000, we will have an invoice from the insurance company for $1,000. If we were filling out the loan forgiveness application form, we could only claim $500 of that, because that's the only out-of-pocket expense we had. The other would be the employee's contribution, and that wouldn't be an expense you could include, but you would be able to include their gross wages. The other things that you need to do is be able to track the average number of full-time employees per month from February the 15th to June the 30th, or from January the 1st to February the 29th. This becomes sort of more important when Julie goes through the calculator with you, but it's important that you've got a list of, and you can work out based on hours, all your employees, to work out how many full-time employees you had in these two periods of time. If you happen to be in a business of seasonal workers, then there's special rules there, which if that impacts you, we can always talk about that offline. Next slide, please, Julie. And then you've got your non-payroll expenses, which is your mortgage interest payments, your rent and lease payments, and utility payments. I think the important thing to make a mention here is that for any of these expenses to be eligible to be part of that, at the moment 25% of the pay down, you had to have these services or agreements in place. So if you had a lease agreement that you've just signed since you've received the monies, you can't offset it against that. Basically, everything had to be in place. So you had to have if you were leasing equipment, you had to have that in place before February 15th. With your utilities, those would have to be in place before February 15th. So if you've got any new agreements that you've set up since this has all taken place that are within the, I suppose what Julia goes through towards the coverage period, then in effect is you can't count those towards the expenses that you could deduct. Now the other thing is that you need to keep these documents and the backup for 6 years after the loan date is forgiven or paid in full. So based on this new legislation, it could be that if, for example, they do change the legislation and you go out to 5 years that you can pay off your loan, it would appear the strict reading of the rules says you would have to, from today, in effect, that documentation would have to be kept for 11 years. However, if you put in your application, say the end of July, and it got forgiven and it was all forgiven, so there was no loan there at all, then you'd only have to keep it until 2026. So just be aware there's a long retention period. So either when you've got all this package put together, scan it in a safe place, or make sure that somebody knows where that binder is if ever you need it at some later date. With that being said, I'm now going to hand over to Julie, who's going to go through some examples to try and give you an idea of what's going on, and then go through some example calculations.
Hello, everybody. I'm in Cleveland, Ohio, and I hope you're all doing well throughout this. We've set up some examples to share with you. They're pretty basic, and that was intentional. This is just to give you a general idea of how the methodology and how the SBA is determining the amounts that should be forgiven or unforgiven. So there's 4 examples here, pretty basic. During the 8-week period, the company received $100,000 of a loan, they spent $75,000 in payroll, leaving $25,000 for non-payroll costs, which can be used for mortgage, interest, rent, and utilities. If that's what happened, and you used $75,000 for payroll, all of those funds would be forgiven. In example 2, same set of facts. The business spends $75,000 in payroll cost of the $100,000 of the loan. However, you had to reduce your full-time staff by 50% prior to February 15th, and you have no plans to retire. In this situation, because your staff was reduced by 50%, the loan forgiveness amount would also be reduced by 50%. In the next situation, same set of facts. Instead of reducing the workforce, you reduce the salaries below 30%. And in that case, if you reduce salaries and don't intend to increase the salaries back to prior levels, then in that case, your debt forgiveness would also be reduced by 5% because the SBA is allowing a 25% threshold for salary reduction. But if you go over that amount to say 30%, then a 5% amount would be taken from the forgiveness allowance. So that would leave your forgiveness amount to $95,000. And then finally, in example 4, this is kind of a combination of both the situations. Same facts apply here, $75,000 of payroll costs, $100,000 of a loan. You reduce the full-time employees by 50%. So here then your forgiveness amount is reduced by 50% as well. And then in addition, there's a 30% decrease in salary levels. And then that also takes another 5% off of the remaining forgiveness balance. So in big picture, this kind of shows you what the SBA is trying to get at with respect to the different calculations and forms that you're seeing on the forgiveness application. And obviously, in light of what got passed through the Senate last night, a lot of these calculations are going to change. But I just wanted to share with you kind of a big picture what they're after. Now, we're going to go into the calculator. And here is a link that we wanted to share with you. This is from our AICPA, our American Institute of Certified Public Accountants. Rob, as you heard, has been listening to their webinars religiously throughout this process. We have a lot of faith in this organization, so we're kind of going with this as our go-to calculator. You can easily Google things online and you'll get a ton of hits on this. People are trying to sell these calculators to everybody right now. So hopefully you'll use this calculator after we walk through it. You'll be a little more comfortable with it. In addition, our staff here will be using that to help you as you have questions. Before I get into the calculator, I just wanted to share that in preparing for the webinar, Rob and I wanted to have some just some sample data in the calculator to use. And as I was trying to assemble that and come up with numbers, I realized that I really needed another document. I really needed a summary of the payroll that happened throughout the year. And so I wanted to share that with you first. And the reason why I needed this is because once you get into the calculator, there's a lot of questions that it's going to ask, and you need to be able to pull certain information by date. It's very date specific. So in doing, even just for a simple, webinar example, I ended up coming up with this spreadsheet. And it's important to understand when pay periods began It's important to know when pay periods end. This is because when you get to choose the date of what you want your loan period to be, there's a choice there you get to make. So it's important to be able to capture the payroll by pay period, or you can also choose when the payroll is issued to employees. So these three things are important. The next column is the quarter. When we run the calculations to determine if there was an increase or decrease in your wages or your full-time equivalents, the base period will be the first quarter of payroll. And you probably know that the first quarter, that the reports that you file with your payroll provider are run off of the check date. So to determine the first quarter payroll, you have to come up with your numbers based on the check date that when the checks were issued. I should also mention that I don't know if payroll service providers are working up something like the spreadsheet for their clients so they can use this in the forgiveness calculation. I know they did a spreadsheet for clients when it was time to apply for the loan. So maybe they're in the works of coming up with something like this, similar to this for you to use in the forgiveness application. I'm not sure. I haven't asked, but hopefully there's something.
Julie, it's my understanding, being on the webinars on a weekly basis, that I think gradually, when the rules become final, the payroll companies will most probably be able to help provide us something as some raw data to try and populate this.
That's true. It's because if they run these things and then the factor amount changes, then they have to go back to reprogramming. But even so, it's a pretty simple table that I've created here. So as I mentioned, the pay period is important, the check date is important, and also important is the number of hours worked by person, as well as their wages by pay. So I've established that here. And then finally, in column O, I created a FTE for the full-time equivalent calculator. I just took my total hours worked divided by 80 for the pay period to determine my full-time equivalent. That's an important number for you to use once we get into the calculator. And then finally, I thought it's a good place here to add on the state unemployment taxes that you may pay as part of your payroll run, as well as any local taxes, because these also are payroll costs, but they're not captured in the calculator. So this might be a good spreadsheet to just maintain, certainly build now as you're going through the paid period and spending the money. At least you have this data in one place, and that when it comes time to run the calculations and apply for the application for forgiveness, that you have the data in one spot.
Julie, it's my understanding from here that a couple of good important columns there is your hours column. So my understanding is that if somebody did in the period of time work some overtime in your column E or G, that you're 80 on a weekly basis. The maximum hours you can have in is 40, isn't it? So you couldn't have an employee that was at 20 hours and wanted to do 60 to get 2 full-time equivalents. Mm-hmm. The 60 would be limited to 40, so you'd end up having 1.5 people for the week, wouldn't you?
Yep. And I guess I'll just mention that the other reason this is important is because the calculator is going to determine the individual's salary during the first quarter. It's going to gross up to an annual salary, and then it will also calculate hourly rate if the individual is an hourly employee versus a salaried employee, and that's how they do the comparison between what was paid in this first quarter versus what's paid in the second quarter, or specifically into the covered period, which is it's a 2-month period. Well, as of the date of this calculation, it was an 8-week period. As of this morning, it's going to be a 24-week period. So even so my advice to everyone is just to start either building something like this or seeking out help from your payroll provider that you can capture this data and you can understand in one place who worked what, when, for how much, and those dates. Okay, I'm going to switch to the calculator now. So this is obviously has a lot of pages, a lot of tabs, a lot of information. As I mentioned, this is from AICPA. This is drafted as of June 1st. Things have changed already. The blue cells you'll see are places that you need to input information. The green cells will carry forward from other locations. So what's going to happen here is we're going to build a lot of data, and it's going to carry forward into the final tab of the PPP Forgiveness Calculator. And so in here, the first magic number that you need to know is your PPP loan disbursement date. This is when the date that your funds first came in. If you receive funds in multiple disbursements, it's still the first date your funds came in. So we're going to use April 1st in our example here. The next question is that you'll need to complete is the alternative payroll covered period. This is where you have some choices, and so this is the important date, and this is why you build that payroll journal summary so you can see what's most advantageous to you depending on the date you pick. So you can pick the date you first received funds of April 1st, or if you are a bi-weekly or weekly payroll payer, if that's your filing frequency is bi-weekly or weekly, you may choose the first pay period, the date of the first pay periods. That's why the date the pay period begins is important in the Excel summary. You can pick the date the first pay period begins after the funds were received. So depending on the facts of your situation in your business, depending on when maybe you had to lay some people off, or you had to furlough, or you had to cut hours, depending on that date, you may decide which date you're going to pick here. So in my situation, the first date of the next payroll period after I receive the funds is April 13th. So that will be the 8-week payroll period coverage date. You're going to have, if you choose an alternative payroll covered period date, you're going to have, you'll start your 8-week calculation as of April 13th for the payroll costs, but for your non-payroll costs, you're going to use the April 1st date. So this is the summary tab, but there's a couple things you need to fill in here before you go to the back data. So as I mentioned, those are the date fields as well as the actual amount of the loan that you received. In this case, I'm using $50,000. So that's the basic data. I would say the next step would be into the non-payroll cost tracker, because this is pretty straightforward. Again, input data into the blue cells. So this is a good place for you to build your file of non-payroll costs. As Rob mentioned earlier, you need to have supporting documentation for these payments, as well as for documentation that these obligations were in place back in February 15th. So if you have copies of utility bills from February, I would save those, as well as the utility bill, copies of invoices for the amounts that you're looking for forgiveness on. A couple things to manage here or to consider here is that the amounts eligible for forgiveness are the amounts paid during this 8-week period, and you'll see that the 8-week calculator is using that April 1st as the start date. So you can apply for forgiveness for the amounts you paid, as well as amounts and as well as expenses that were incurred. So here, if we paid our April rent April 1st, we would include that in our calculator. But if we get to the end of the 8-week period and we are trying to maybe up our non-payroll costs in our calculator, and we feel like we could prepay our June rent before May 26th, I would recommend you go ahead and do that. And then you can also include that June rent in your calculation.
Julie, I think it's just important to maybe just clarify is we've been talking about the covered period and the alternate covered period. The covered period is always under current rules 8 weeks from the date you got the loan, and the non-payroll costs have to be under the covered period dates, don't they? So they have to be within 8 weeks of you receiving the loan. It's the payroll you get the choice on.
Right. Absolutely. The payroll, you get to play with the dates a little. If your pay period begins, after the first payroll period, it begins after the date you first received the funds. But for non-payroll costs, for your rent and your utilities, you need to use the 8-week period that begins as of the first disbursement date. Okay.
In reality, the way that they've set it up with this paid or incurred, you potentially sort of could have 3 bills that you sort out in an 8-week period, isn't it? That's the idea.
That's right. And that goes for payroll, that goes for non-payroll costs as well as non-payroll and payroll costs. But the instructions show that any amounts paid or incurred. So I believe that, if there was, like they've talked about on the payroll side, if there was a potential bonus or something that could have been accrued or received, or someone earned that benefit in that second quarter, you could include that as well. Not sure how many bonuses are happening right now, but or commission, something like that. You could include that in your payroll. So that's pretty straightforward. Again, trying to capture your data in one place so that you can use it in a calculation is probably the most important thing. Also, I would have added in this spreadsheet a place where you could detail out what period each of these expenses covered in case of trying to obtain that third week of it, or the third month of expenses in your forgiveness application. Okay, so now, well, let's go to the full-time equivalence input. You saw in my payroll summary how I calculated my full-time equivalents for each pay, or if each pay period. In this full-time equivalent input screen, this is where you would feed that information. It's going to compare the full-time equivalents as of February 15th. So that's kind of like your base. And then it will compare those full-time equivalents to full-time equivalents you calculated from February 15th to April 26th. So in my case, my full-time equivalents have come down a little, and so then this will go through that calculation. And then it also follows up with the question that Rob mentioned earlier about what is your intent to rehire and reestablish people before June 30th. Now I think we're hearing that might change to December 31st. Obviously, that's an assumption that would go into your application. But if you are comfortable saying, and maybe this is something else you need to document, and you're kind of in that memo file that talks about why you took out the loan in the first place, but also to document your plans for bringing people back to work. That would help support your assumption in the application if you say that you're going to bring back everybody. Again, if you plan to bring back everybody, there's no reduction in the forgiveness calculation for the full-time equivalent.
Julie, my understanding is this: you can get sort of like a special dispensation if there was somebody you had to lay off and then you've offered to rehire them and you've given them the job back at the same pay, but they've refused it. That can still come in as part of the full-time equivalent, my understanding.
Yep, that's also in the details of the instructions, that if there were certain people that were offered their jobs back but it didn't take them, then you can take them out of their, yes, that's in note 1 here. Talks about people who they voluntarily resigned or didn't come back. You can take them out of the calculation. So that's the full-time equivalent side. Now I'll show you the payroll accumulator tab, which has got a lot going on, and it can be a little overwhelming. Just to remind ourselves, the purpose of this is to track and compare the payroll from the first quarter of 2020 and compare it to the 8-week covered period, and determine the reduction in wages. And then also this will calculate a safe harbor. So here we go. So here's a quick summary of my 4 employees in my example: Amy, Ben, Chris, and David. You will want to assign them if they're salaried or hourly or other. In this case, I've got 2 salaries and 2 hourly. And this next section is where you're going to pull the data from your payroll summary Excel and input the gross wages for each of these individuals. For the first quarter, the calculator considers the $100,000 limitation for folks who make more than $100,000. You guys are aware of that as part of your application, part of the application for the loan, that you have to limit the loan request amount to folks for $100,000 of wages. You input the number of weeks that were paid to the individuals. You input the number of hourly or weekly hours. Then here it determines the base period average annual salary, or the hourly wage paid to each person. So this is our base section. Here comes the covered period. This is where you pick your date. This is where you decide if you're going to use April 1st or April 13th. And here I'm showing that Chris had a reduction in compensation, but it didn't reduce his hours. In the case of David, his hours were reduced, but his rate stayed the same. And then the next section is to calculate the difference here. And so this shows that in the case of Chris, his payroll was reduced by 24%, and no change for David because his hourly rate did not change. And then it moves into the forgiveness safe harbor, which, as we know, is now dated. This kind of runs off the 75% threshold, which now is going to be reduced to 60%. And from there, it calculates any reduction after the safe harbor. So given that all this is changing, I just wanted to kind of give you the lay of the land, to show you basically how this works. And then what will happen is if there's a reduction down here, then this feeds back into the first or the second tab, I should say. This brings forward our payroll costs. It brings forward our rent and lease payments, utility payments. Here's that accrued interest amount that Rob mentioned earlier, that you would be liable for. And it goes through the calculation. It compares the total loan amount you received. It takes the lesser of the loan amount of the eligible 75 gross up on payroll and the expenses that you paid, qualified expenses for forgiveness, and it takes the lesser of the 3, and that being our loan amount of $50,000, 100% of the loan is eligible for forgiveness. Like I said, there's a lot going on here. There's a lot that's going to change in the calculator, but I would suggest that this is a good calculator to use if you're getting into the nuts and bolts of it all. Rob, anything you want to add here?
No, I don't think so. I think you've gone over that well, Julie. I think the only thing that's most probably going to alter is the certain percentages or the PIP coverage periods. I suppose from a practical perspective, I haven't sort of known anybody that's actually submitted the documentation yet. So I think there is still some unknowns with that. But I suppose it's just knowing how many loans were taken out and what we saw of sort of the chaos to a degree that we saw when all the loans were done. I think part of the reason the banks have sort of shut their doors, or some have, because they've just got too much paperwork to get through. So I'm just thinking, I don't know, I would imagine either when you're ready to have the loan forgiven, you want to get your application in sooner rather than later, so it's at the front of the queue. Even if you have the ability to spread it out over 24 weeks or something, if you can meet those requirements, I'd almost say it's going to be better for you to get it in to start with, because my understanding would be is that, I know it's not a lot of interest at 1%, but you'd still be accruing interest until it's forgiven. So if you're in the queue, and I just wonder how much more time it'll take when it gets further down the road, and whether, at the moment, I believe they have 60 days to turn it around.
Right.
And then if they need more information, they can come back to you and say, you've got to provide it in 30 days. But I just imagine, my gut's just telling me is they're just not going to be able to process all this stuff in 60 days. And that might be why another reason they've gone to maybe 24 weeks, so that they spread them out further. But I would say just get it in as soon as you can, and hopefully the process goes fairly smoothly for you.
All right, you mentioned before that there was 4.4 million of these applications, so there's going to be 4.4 million applications for forgiveness.
Mm-hmm.
If our clients have, if their business kind of followed suit to what they expected when they made the application and their numbers pretty much line up, I would suggest they go with, they get stuff in with the 8-week timeline if they can, if it's supported, and then hopefully that can kind of close this all up faster.
So I've just got a couple of questions here. Thanks for that, Julie. We've got a few minutes just left, so I just had a couple of questions come through, so I will just address those. So one question talks about there was a loan application that was submitted, but unfortunately it got misplaced. And what should we do now is, I would suggest, based on what we're seeing, is depending on what it is, if there's any way that you're able to maybe fax it across or email it to them so it can be started in the system, and then I'd maybe see if you can FedEx it to them. But I think the first port of call would just be to call whoever the provider is and just check that they are there. We know there's still monies there, and when we read the press, there's still monies, but for some reason, the banks or the loan providers are just saying they're not accepting any, and I can't get an answer to that. But I would suggest that you most way just call up and double check that they are still accepting applications, because there certainly still is money there. We've got a question about the interest on the loan. Once again, it's my understanding is the 1% interest starts accruing from the date that you actually get the money into your account to the date that you pay it off. So I'm pretty sure it's a 1% annual rate, but accruing on a daily basis. And once again, is if you ended up having the loan and it going out for 5 years, then it would accrue out to 5 years. Now, the interesting thing that I don't think they've changed is there was going to be no prepayment penalty. So if you paid it off, so say for example you borrowed 100,000 and you go through the calculation and you were able to get forgiven 80 and you've got 20 left. If 2 months later things were turning around and you wanted to pay off that 20, you could just pay it off with the interest with no prepayment penalties. One interesting question that had been thrown out to me when I was talking to a client about this was, if you're in a situation that from a group perspective that you have financial reporting requirements that you have to disclose, or you've got loans, say for example you're a UK parent, you've got loans in the UK and you consolidate your US operations together, will this PPP loan have any impact on your debt covenant ratios? And the other thing as well is whether, because normally, as everybody would expect, if you've got a business and you have a loan forgiven, it's normally a sign that the business isn't doing very well and might make the bank a bit jittery. Whereas this forgiveness is a loan that's been forgiven, but it is strictly a loan that was set up to be forgiven. So I would imagine if you've got situations in your group that you might have that, it might make sense just to start thinking about that if that's got any issues as well. Hopefully not. And then talking about, with respect to gross wages, as far as we're aware, gross wages means anything that you pay to them. So if you've got a salary, you've got commission, you've got a bonus, and anything that you would normally go in as on their pay slip, if there was an auto allowance or a housing allowance or that would be subject to tax, as far as I'm aware, that would all be gross wages. So with that being said, we've just got a few minutes left. Those are the questions that we had. I want to be cognizant of everybody's time and make sure we finish on time. So really just want to, maybe just a couple of takeaways from my perspective is that obviously, as we've all seen, and those of us who are involved with the UK as well, things are changing on a daily basis. Hopefully in the next couple of days, this new bill that will be signed off by the president will come out. And like I said, is we will, we're more than happy to do another presentation in a couple of weeks' time when hopefully everything's a little firmed up a little bit more, and we can maybe walk through some more examples to really explain how a situation works so that it helps you follow through. As you start working through these processes and start doing the calculations, we're certainly more than happy to help go through and clarify and check the calculations for you, and maybe look at the analysis and just see if it's close one way or the other, if there's a best way for you to file. I know there was one or two people who signed up who are self-employed. If you want, because we didn't specifically touch on self-employed people today, if you want, the AICPA has got a nice little document out there for self-employed people with loan forgiveness. If you just email me, I can send you a copy of that.
There's also in that calculator, in the payroll accumulator, there's a place to capture self-employed payments too, with some underneath.
That's good. Thanks, Julie. So I haven't got anything else. Julie, do you have anything else?
Nope.
Okay.
So
so
keep us in the loop as you're going through the calculation, I would hope.
Just know we're here to help answer any questions, give you an update of where everything is, and then we will, I was going to say, thanks very much for attending today, and please stay fit, safe and healthy. So take care. Bye-bye.
Bye-bye.